Ladies and gentlemen, welcome to the Capital Flows live stream. All right, we're on. James, are you coming through?
I'm here. What's up, guys?
Good to go. Well, thank you for joining, everyone. We have really interesting ideas to cover today, especially as it relates to all the news that we've had come out overnight for the geopolitical situation, how it impacts markets. You know, I've been sharing a lot on the Substack with everyone, kind of explaining how exactly these different flows are changing out. Especially, I mean, one of the main ideas that we're going to cover today is on the FX side, because that's pricing things that actually the physical oil market's not going to price, and it can't even price. So I think there's going to be just a lot of really interesting ideas to cover. If you guys are here and you're watching this on Twitter or YouTube or whatever it might be, put something in the comments section, whether it's a question or where you're at in financial markets or what you're focused on, so that, you know, all of us can get an idea and that we can make it relevant for you. And then if you're on Twitter or wherever you have social media, if you guys can share the live stream, retweet it, whatever it might be, always appreciate it. And I think one of the first things that I just want to start with to remind everyone, we're going to be doing, well, I am. Hopefully James can join more. Live stream every single day, 8:30 a.m. Mountain Standard Time. I think it's right now, the time zone, it's 11:30 a.m. Eastern Standard Time. And the entire goal that I have for my trading, and James and I will actually talk about this a little bit. I mean, this is just really an extension of what we're doing every single day, is mapping the macro regime so then you're on the right side of it, and then find a few large asymmetric bets within that and run home run trades. And if you are here and you're trying to go through all the different charts and you want any of the breakdowns, the models that I'm going to go over in this live stream, if you go to capitalflowsresearch.com, all the charts, models, breakdowns, everything for this live stream will be posted there, 100% free. So if you want to go through all that stuff later, which I'd encourage you to do, if you're, you know, someone who's trying to invest in your knowledge and spend time, not just going through the content cycle and all of the short-term clickbait stuff that happens, but you want to build a knowledge base over time, then go download the slide deck, feed it into AI, and then ask AI, hey, how would these ideas relate to my trading strategy or what I'm doing? And spend time investing in whatever that might be. And then for everyone who's a paid subscriber, every single day I'm sending out a report that goes over all the proprietary models that I have. I covered some last night, which was really interesting, going through a lot of fundamental equity changes. And so interest rate FX strategy, the equity strategy that I'm running, all the structural macro reports, those are for paid subscribers on the Substack. So everything is laid out there at capitalflowsresearch.com. And James, any initial ideas? I know you've talked about this a lot, but just the idea of building a base of knowledge over time and why that, you know, sets you up for success, instead of just saying like, well, let me just scroll through Twitter and then kind of click in and out of markets and hope for the best.
Yeah, I think that's a good framing, because for somebody like me who has figured out how to survive, but I don't feel like I'm exactly right curved in any specific area, what I've come to realize in the last like 5-6 years is that what I am good at doing is synthesizing a lot of different information over a lot of different topics and figuring out how I could implement and cross-pollinate all that stuff into building up trades. And because of that, I start to think, oh, since I'm thinking about certain things and certain markets and certain topics of interest, nobody else is going to be thinking the same way that I am, which to me can develop an edge, right? Which is why I always mention on my stuff, like how I don't love the idea of just like copy trading somebody's strategy, or like this strategy is a lay it over markets and it's going to work for you. Like right. We talk a lot about like leaning into like our strengths, our edges, compounding them on top of each other, and then figuring out the best way to express those trades. So that's how I think about how I approach like what we're doing here every day, how we're looking at markets, and yeah, that's how I think about things.
I like it. Yeah. I think that one of the things that we'll cover today, I covered this a little bit on the live stream yesterday, is just how exactly, this is something that people don't spend as much time thinking about with foresight, but what are all of the possible things in the future that could take place? Because, one of the things I talked about yesterday is, as we're moving into this period of time with the IPOs, with OpenAI, SpaceX, Anthropic, and everything like that, this is a very unique situation where you have all of these AI companies that in themselves are changing the structure of the economy, and now they're going to go IPO. And it is very likely. I think it's almost certain, but it's we haven't had it happen yet. So, but it's a probability. But I think it's just so likely that Anthropic, OpenAI, when they go public, they are going to launch a bunch of models into that. But so before it, right? Just to get a lot of animal spirits and people, retail institutions, everyone kind of foaming at the mouth. I don't care if people think like, well, we have all these fair value models for how institutions are going to price things. When you have a cap table and everyone realizes that, only a percentage of that cap table, a percentage of those people are going to be able to invest in whatever the latest and greatest startup company is, they throw all of those valuation models out the window and they say, you know what, let me just buy. I can't not be at the table, because if my boss finds out that I didn't invest in OpenAI or Palantir or Anthropic in their seed round and it goes IPO at $1 trillion, I'm just going to get fired. Right. And so, it's not just this like, well, where are they valued? Where are their cash flows and things like that? I think those are important things to understand. But in a trading sense, thinking about markets and where we're at, it's very likely, if you know that that's a possible future to take place, it hasn't taken place yet, the markets could try to front run that. And the markets are always operating off of, they're pricing future uncertainty. So inherently, they're going to price something that we don't know is going to take place or not. And so if you're always thinking about things that are not taking place right now but could take place, it's just going to set you up incredibly well to actually respond to things when they take place. So for example, if we have those IPOs, but we know that the equity market or these other markets are trying to front run it, then, if you're one of the people that like the IPO finally comes out or whatever it might be, and you say like, oh, now I want to buy the market because all of this positive stuff is happening. Understanding that it's pricing that as we move into it is a pretty big differentiator, just as you're running into it, so that you're not the guy who gets kind of caught in the sell the news event, right?
Yeah, you passing it to me. I totally agree, and I actually am shocked at how maybe relevant this still is. Right, like it's starting to feel obvious as to like, hey, markets are a good kind of forward pricing thing, and that people should be quite aware of like what the IPOs of these things are going to be and all the different rounds leading up to it and the models and the expectations. Like, it's becoming a little bit obvious is like, hey, wait a second, caution light upon these releases, right? It's kind of like we talk about the hedging of catalysts and stuff in the markets. It's
Right.
like one of the reasons I feel like I've been kind of bullish around these lows in the war stuff is because I'm like, it's so slow and so uncertain that everybody has built up these defensive books that like make it harder for it to actually play out like a crazy down move, right?
Totally.
Whereas like COVID and like even the tariff tantrum was a little bit more like shocky, unrealized, like kind of out of nowhere. People had to scramble. People weren't really sure what to do. Whereas like here, the buildup to these IPOs has been so long and just so much attention on the AI space. It's so much money moved around and debt and little Gardner hype cycles along the way. Like, it's almost obvious at this point that like, hey, when the IPO happens, like, wait a second and think, right? But
Yep.
I'm sure we'll be shocked at how many people just like ape the Anthropic IPO or the SpaceX at
Yeah.
2 trillion or whatever. Well, it's 2 trillion, might as well go to 10 trillion, right? Like,
Yeah, it's always I think that's one of the things that we've talked about a little bit. I'm always running. I think this is why understanding the macro regime is so critical here, because you can compare it with what is taking place in markets. But when I look at not only the macro liquidity side, but just where expectations about the market are, this entire idea, if you just remember back in 2021, people kind of came out of nowhere with just random stuff, and everyone agreed that it was so likely. Like, oh, this is going to totally change X, Y, and Z, and this is going to happen. And you're just like, I don't know if that's going to happen. And they're like, oh yeah, it's going to happen. We have a 100 billion valuation on this thing. And you're like, whoa, like where is this coming from, right? And then you look at macro liquidity and you say, okay, what's strong right now? And then you say, okay, well, maybe things are shifting on the margin. And then, once you have, I'm still shocked that people don't spend time understanding interest rates, because the entire 2022 bear market was driven by interest rates. It was driven by inflation. And so I just think that's one of the most important things to understand. And we'll go over, for everyone that's here, we'll go over all the changes to the macro regime that are taking place right now. I'll switch over to TradingView. I'll also share a lot of the models. For anyone who is brand new, you're going to want to go to capitalflowsresearch.com. Every single day for these live streams, I'm sending out the entire slide deck, models, everything else. So here's the one I sent out last night. You have a total breakdown of all the ideas. So if you want to feed this into AI, or if you have a day where you have a little less time and you want to just go through what are the main talking points that I covered in the slide and the stream, all of them are laid out every single day here. The slide deck for yesterday's stream is here. The TradingView models that I shared in real time on the stream yesterday for how to price these different moves are here, linked for free. I'll have another TradingView model that I'm going to cover today, and I'll share that in the piece tonight. And so the entire focus, and then I'll always put the next live stream link here. The entire focus that I have right now is, I strongly believe that we're in this period of time over the next 6 months specifically, where not only on the financial market side, but also on the economic side, we're having a retooling with all of this industrial manufacturing side as robots are integrated, this entire theme of zero gravity manufacturing in space that is getting tangible acceleration. People aren't talking about it because it's all in the private market, and the only thing that people have as a baseline is SpaceX. But if you talk to anyone in the space industry right now that's doing manufacturing and parts in the space industry, every single one of them is going to tell you that things are moving at an insane pace, and there's massive backlogs, and everyone's working overtime just to get all these things out. And so all of these different factors are lining up literally within the next 6 months. And I've just realized how important it is, which is why I'm going to be doing this live stream every single day at 8:30 a.m. Mountain Standard Time. And I'll be sharing all of the AI models that I build, TradingView models, all of the different ideas that I'm covering. And my entire goal is I'm, working and building all of this stuff. And if you're a subscriber on the Substack, even a free subscriber, you'll get all of it. And I think the reason why I'm doing these in a little bit of a longer format is so that everyone who is here, you can intentionally invest and spend the time that you need to spend so that you're aware of what's taking place and you're on the right side of all these changes, even if they're small, right? Like, even if you're someone who has just a basic portfolio and you're trying to maneuver around things, or you're trying to get kind of an edge in whatever domain that you're at, just spending time being aware of these different factors and exposing yourself to these macro changes are going to be massive. So the first thing that I want to cover as it relates to markets is the changes that we just saw in GDP this morning, and the new changes in the PCE data and all the economic data that we came out today. There's this entire question in markets right now that is about how much inflation risk is in the system and how much growth exists in the system. And this actually directly connects to stocks and bonds. And what we saw today is the GDP print come out at, basically 50 bips of acceleration on a quarter-over-quarter basis for the most recent quarter. And we're still seeing the changes in consumption. So you can still see on the screen right here, you are still having consumption rise. Not sure why that's doing that right here. And that is continuing to allow the US economy to move forward. We have some shifts in government consumption, but the chart that I want to share on government spending right now is that right now, and then also in the projection that we have from just the fiscal trajectory of things, the primary factor that is going to drive markets is, and especially the government spending side for interest rates and liquidity and things like that, is the fact that one of the largest contributions for government spending is going to be interest payments. And the chart you can see here is of how much interest payments are going to contribute over the next several years. And this is going to drive markets because government spending isn't going to stop. And let me pull up this other.
That's scary.
Yeah.
Scary or maybe great. I don't know. Let's try to stay optimistic here.
I think that this is definitely going to be a driver moving forward because in the financial market side of things, they're going to have to fund that in a way. And that is always going to be connected to the quantity of money in the system. And so I think, my view is that the rising debt service costs are going to push around bill issuance, long-term debt issuance, and everything kind of along those lines. Give me 1 second. Let me make sure this is, here we go. So this has been one of the largest factors driving things. But when we connect this to the U.S. labor market and where we're at with the larger picture of, okay, is growth weakening because of these oil prices? Initial claims have still been in this range right here. So growth is not collapsing right now. And the fact that we just had an oil shock, one of the largest oil shocks in history, and the labor market has just been fine, especially in the United States. They've had some issues in some other countries, but overall it's been fine in the United States, is an indication about how resilient the system is right now and how much money there is to help warehouse the risk that is taking place. And so the initial claims data that came out today, it's still in this broader range, which is why I'm not really interested in shorting equities right here. And then when you connect this to where we're at with inflation, the PCE data that came out this morning doesn't, we're still waiting on some of the timing, but the CPI print that's going to come out this week is really going to reflect the changes in energy prices. And you can see here's the forecast of where we're at with consensus expectations around CPI. One of the things that I laid out in the live stream yesterday, which again, you really want to build these live streams on top of each other. You want to listen to them and spend time incrementally stacking these different pieces of knowledge so that you understand the different tensions. Everyone can go into an AI and understand all of the moving parts, or they can get all of the kind of the pieces of the puzzle together. But being able to take those pieces of the puzzle and say, this one goes here, this one goes here, and this is how each of them connect, that's a totally different game. And AI is still not doing that because AI is still functioning off of public data sets and not private data sets. So the most important thing that you can do for AI right now, especially if you're trying to develop an interpretive lens, is either get private data or build your own interpretive framework. You have to do one of the two, or else you don't have differentiation. And so the key thing for markets right now, if we're going to take this and say, okay, well, we know that expectations are higher for the next CPI print, the key thing will be on core CPI. Because if core CPI begins to accelerate, it will be an indication of how strong the headline inflation number is transmitting into the underlying economy. And what I would say, broadly speaking, is we're seeing growth weaken a little bit. We're seeing the labor market just kind of wobble a little bit, not a ton, but not enough to cause long-term inflation expectations to rise. One of the charts that I shared yesterday in the stream that I shared with everyone was about where we're at with long-term inflation swaps. Because on a, when you look at inflation swaps across the curve, and let me pull up this chart right here so you can see this. Hang on. This is a little slow. Come on. I'll have to move back. I'll have to come back to this. The inflation swap side, long-term inflation expectations functionally haven't moved. I'll go through a chart in a second on that. And so the tension that we're in is that my view is that you want to be long stocks and short bonds as a pair trade right here. And if you're saying, well, I don't really like shorting things, that's fine. The idea is that stocks are likely to outperform bonds because this inflationary impulse is significant, but it is not enough to really take us into another inflationary cycle, but we still need to let it normalize a little bit. So my view is being long stocks over bonds is good. And being long gold over bonds is also a really good idea as well, because the supply side inflation needs to make its way through the system. Once it normalizes and begins to consolidate a little bit more, that's when you can kind of get long bonds again. And I'll actually share this chart because this is a model that I'm going to share. So if you are on the Substack, then I'll send out this model later today. But here is the momentum between stocks and bonds right now. So what you can see is that you just have ES right here, and this is just the cross-sectional momentum indicator that I built, and that's available for everyone. So if you go to capitalflowsresearch.com, I'll link it in the report that I do today. But you can notice here, stocks and bonds are moving down in lockstep. Why is that? It's because this sell-off is driven by a short-term inflation spike with higher crude prices. So stocks and bonds going down at the same time. That matters for portfolios because you have to remember that most just investors hold a stock bond correlated portfolio. They hold some type of 60-40 exposure. And when you have that, that means that if both parts of their portfolio are going down at the same time, they're more sensitive to drawdowns. If you actually look at the inflationary bear market of 2022 and that whole period of time, when you had stocks and bonds go down at the same time right here, people actually lost more money in their portfolios than the 2008 Great Financial Crisis because stocks and bonds went down together. So think about it. If someone who's holding stocks and bonds in 2008, their portfolio, sure, stocks went down, but the bond part of their portfolio offset that. You can see here in 2008, you have bonds rising and stocks going down. So people who are holding 60-40 or a diversified 60-40 portfolio, they're kind of offset. They might be right here and they might say, well, sure, stocks are down, but my bond portfolio is up, so I'm not super worried about it, right? But and obviously stocks going down a ton impacted people's portfolios, but the fact that bonds rallied helped offset it. When you have, and we had stocks go down, I think it was 57% from the all-time highs in 2008. When you have stocks go down, I think this was a 20% 20 or 25%, maybe 30% drawdown from all-time highs in the S&P. When you have that happen, but bonds go down at the same time, you can functionally lose the same amount of money. And that's why it impacted people so much. And that's why this entire regime that we're in now, where inflation risk is higher, is so critical to monitor. And so when you have these shorter term spikes of inflation risk pushing markets in one direction, people get a lot more scared. And so my view, and I laid this out on the Substack and everywhere else for paid subscribers and everything like that, about being long equities and how, especially at these lower levels, when you have the Russell rejecting these levels, all of those are signs about where we are in the system. And now you can notice right here that stocks are likely to outperform bonds. We're actually seeing that on the day. Notice how ZN right here, it hasn't made a new high above yesterday's high. But stocks, ES specifically, is making a new high. NQ also about to make a new high. The Russell, very close. ES specifically. And then the implication here is that when stocks outperform bonds, it means that the inflation risk in the system, it's helping benefit stocks, and it's not as negative for stocks, but it still has a kind of neutral impact on bonds. So you want to be careful of just being aggressively long bonds. And it's more likely that stocks are likely to rally, and that's a better play. And so that, and again, I'll share this visual right here. If you want this indicator, this shows the relative performance of stocks and bonds. You can even see, right here, how stocks, underperformed bonds right here. And then, we're kind of consolidating in this range right here. This, level is probably going to break out right here, especially if we look and we shorten the look back just a little bit and we see on a shorter term basis, you're already having stocks outperform bonds right here. That matters because when we think about how high equities can go, my view is that equity is going to move to all-time highs, in probably short order, which is why I have some equity risk and I'm long per, and I still think that there's going to be this massive melt up that takes place. And again, I laid out a lot of the mechanics of that. If you're trying to work through what signals should I be looking for? I laid all that out for paid subscribers last night in the Substack article. So go through that. But I'll give this entire template right here in this indicator. That'll be laid out in the link on the Substack today for everyone. So going back to this entire idea of, let me pull this up, of stocks and bonds, this really relates to crude and the FX market. And the place that we are at today, here's the chart that I just shared, is that positioning is shifting a bit in the equity market in the bond market. And I want to walk you through some of these positioning shifts. So here's a Bloomberg article that talks about the final CME open interest data shows traders rebuilding positioning in the 10-year note fall futures on Tuesday. That's earlier this week, followed by a washout in trades seen Monday that marked the biggest drop in risk from the tenor since March 2nd, the first trading session after the start of the war in Iran. Basically, what this means is that we just had a capitulation last week and then kind of Monday, and then that capitulation unwound, which is why bonds have made a bottom. So the 10-year contract open interest rose 6.5 million, DVO1 into Tuesday's price action just means more people are getting long, signaling new long positions supporting the latest rally across the curve. Everyone kind of knows that crude is going to, make a new high. The probability of that just decreased with the news announcement that came out earlier this week. The open interest also gained on Tuesday, so we're seeing persistence across all other Treasury future tenors for a combined risk amount of 4 million DVO1 in the 2-year, 5-year, and the ultra 10-year. And then in both the SOFR futures and Fed fund contracts, open interest broadly rose. Just think about people buying more call or put options, except, we're talking about the future contracts, open interest across the strips, although the size of the gains in risk was relatively muted. Now, let's go through what that looks like exactly. Here are all the future contracts for the bond complex for the CME, and traders are adding and cutting position. But right now you can see in this section right now, open interest has risen. So people are kind of getting leverage long again. They close out some of their positions initially, but now they're kind of shifting their positioning again and getting levered back up and consolidating a bit more. So it's showing that there's not this long-term inflation risk in the market, in my view. And positioning has adjusted to that because they don't think that inflation risk is going to, run through the roof in like a crazy way. And I would agree with that because I don't think that we're at this point in time that you're going to have long-term inflation expectations really just go through the roof or something like that. And here we go. Finally, I got this other chart up. Here are the curve for inflation swaps. You can see 1-year inflation swaps right here, which have come down a little bit. We're consolidating at this level. but they're the ones that have risen over the last month. 2-year inflation swaps are the same. But notice that 10-year inflation swaps and 30-year inflation swaps have actually been falling. So over the last, several, here's 2022 and the inflationary spike there. But you can see that long-term inflation expectations have been falling. So people view that this entire crude move is actually setting the stage for long-term inflation expectations to fall. The short-term inflation risk still needs to make its way through the system, which means that you need to, still wait on getting leveraged long bonds. But that's the tension that we're in right now, which is why these matter, because people are beginning to shift their positioning a little bit. So as this relates to Treasury futures positioning, you have more open interest across the 10-year contract specifically in that part of the curve, also the ultras. And then now notice that the December contract right here has, make sure this is right. The different contracts that we have right here for SOFR, those matter because what I do is I say, okay, well, we just had the SOFR contract for December 2026 have more open interest, which means that more people are betting on a change in the December SOFR contract. Same thing for the September 2027 SOFR contract, and then the March 2028 SOFR contract. And you say, what in the world does that even mean? Well, what we want to do is go to those contracts and say, okay, well, what are those contracts pricing right now? Are they pricing more cuts, or how did that open interest, that change in positioning, overlap with the change in SOFR contracts? And I'll walk you through, these SOFR contracts. By the way, if you go through the TradingView models on the Substack, there's an entire breakdown where you can find this exact tab and you can build it in TradingView. It's an entire indicator in TradingView where you can see this exact same thing that I have here. And let me pull up this. So this entire panel right here, you can download a model and it'll give it to you in TradingView. I'll link it in the report that we have later today, and you can go through all of it yourself. The idea here is that the Z6 contract, which is saying how many cuts do we have between now and the end of the year, is pricing 5 bips of cuts. So previously, it was pricing, whoops, let me put this here. Previously, it was pricing a 25 basis point hike for this year. As you have this move down, what you have is traders getting levered up as you bet on more or less rate hikes and more rate cuts. So traders have flipped their positioning from this high, because everyone kind of knew, I talked about this when this happened. A 25 basis point hike almost certainly is not happening this year. At the very least, with the information that we have right now, it's probably not happening. Could the inflation picture change and everything flip? Sure. But right now, with the information that we have, probably not happening. And so when you see this move down and we price more rate cuts relative to the hike that we priced, that is overlapping with this positioning change that is taking place in the open interest across these contracts. So when you see, this take place where that, December contract is functioning like that. Pull this back up. When you see that taking place, it's an indication about where we are in positioning. And here we go. So I'm always watching how these open interest changes are moving and how that relates to the forward curve and how many cuts we're going to get this year or next year or whatever that might be. Again, if you go to capitalflowsresearch.com, click on this main page, scroll down, and go to all of the models by my friend Alfie, and you can go to his Substack. By the way, if you want to be long and listen to a really good guy who's working really hard, upcoming trader, who is really sharp thinker about markets, you should follow him. He has been going through all the stuff that I've been putting up over the last several years now, and he's been building out AI models and TradingView models nonstop. And he sent them to me, and I said, well, if there's anyone, it doesn't matter who you are, if you've built AI models, TradingView models, really high quality research, based on all the stuff that I've been sharing and everything like that, I'll totally share it. I'll throw it in here in my main page on all the educational articles, and you can go through them yourself. So, this is an opportunity for everyone. If you want to go through all the models that he built, they're all free right here. And if you want to build models, like, I think you should do that. If you want to start a Substack, I think you should definitely do that. I think there's so much opportunity, not only to learn, but to meet other people, to build, and to understand the different moving parts. I mean, I think everyone should do it. I think it's just like an amazing thing that you can do. So that's where we're at with positioning right now. And when we begin to connect this to the longer term chart of crude prices, notice that we are right here, the Iran war. We're having a bit of a spike, but relative to history, just think about all these other spikes that we have had, right? And you have these different geopolitical events, especially, in this run up to 2008, which is really interesting because, I'll be honest, I think that the parallel to 2008, where you had this little bit of a, melt up, is very interesting, not because we're moving into a bear market, but because if the Fed responded to that a little bit differently, which I think they're going to this time, then you probably would have pushed out the bear market of 2008 maybe another 12 months, maybe 6 months. And where we're at right now is you have this entire inflationary impulse, and that is put more money into the system, into the underlying economy, but now you're having interest rates come down, and it's likely to set the stage for lower real rates. So, for example, let me pull up this other chart that we can go through, because this will really, again, I shared this last night with subscribers on the Substack. Here's a chart for 2-year real interest rates. Notice that 2-year real interest rates have just made a new low. So that means that there is now the stage is set for more liquidity to be in the system because real rates have just fallen. So you have this inflationary impulse, but now after that has unwound, real rates are now lower on net, and you're likely to have that create more money in the system that's going to accommodate equity markets pushing to an all-time high. And so you have that on the short end, and you also have it on the 1-year real interest rate, which also just pushed to a new low. So you have more accommodative policy on the short end. And the same thing is happening for 5-year and 10-year and 30-year rates as well. So all of these things are setting the stage. These are real interest rates, not nominal rates. And I shared this also last night, which, again, people are not really going through on the changes in nominal rates. Notice that right here, here's an attribution chart of 2-year nominal rates and says how much of it is driven by inflation versus real rates. And the entire move down in nominal rates, part of it was crude coming down and that premium, but the other part is real interest rates, which just means that real interest rates have a lot more of a connection to growth and the risk premium in markets. So when you have this move down, it means that you are having the central banks and the forward curve for central banks price less restriction in their policy relative to inflation taking place. And so the implication is that we are likely to see more liquidity come into the market over the next 30 days because of this. And so when you think about that, it's going to frame this next chart right here, because the FX market is already pricing these changes. Here's just a breakdown. And again, I'll share all of this. You can get this entire slide after. I'll send it out later today on capitalflowsresearch.com. So you can get all of these slides, all the breakdowns, all the trading view charts I'm sharing. What we're now seeing is traders shift their positioning around how oil is impacting these various countries. So we had the run up in oil. Now, if oil goes down, the question is, how is it going to impact China, India, Japan, and South Korea? Because net exporters of oil, if you think about Saudi Arabia, Russia, Canada, the United States, if oil prices go up, at least for these countries and their GDP and especially something like Saudi Arabia, Russia, or Canada, when the majority of their GDP is on oil, if oil prices are going up, it's helping the economy. They're making more money. With that being said, countries like China or Japan or South Korea, especially, when oil prices go up, they're losing money. So now what people are doing is beginning to bet on the currencies as a proxy play for how well those countries are going to do as a response to these higher oil prices. And we're actually seeing this in the market today. So the article that just kind of came out today that I thought was very interesting is that hedge funds are now placing bets using currency options that the South Korea won and Chinese yuan will strengthen as risk sentiment improves and oil prices fall. So if you have oil prices fall, that's good for China and good for their currency. And then trading volume, now what traders are doing, and they're saying, oh, if this entire geopolitical risk is over, that's going to shift positioning. And now they want to bet on that with the options market on all of these FX pairs. And so what's taking place? I'm going to switch over to TradingView in a moment and actually show you this in real time. The won surged against the dollar on Wednesday, and as the decline in crude took place. So the FX market is directly linked to crude because all of these countries are long or short oil. And so the trading volumes for those have increased pretty significantly as that's taken place. So I'm going to switch over to TradingView, but as a reminder for everyone, all these breakdowns, they're going to be at capitalflowsresearch.com. I'll be doing a live stream every single day, breaking all that down. And all the paid research is on capitalflowsresearch.com as well. And you can go over all of that in your own time and spend time really investing and saying, how are these different moving factors, moving parts work? And again, that's all laid out on the website as well. On the TradingView side, with this FX side of things and how it works, here's what I want to cover. Notice right here how the dollar against the yuan has moved in lockstep with crude prices right here. So you can see right here. Notice how the dollar initially bid, and actually, by the way, the fact that this took place right here, where you had the dollar actually rallying and it was leading oil prices, that's something that people are watching in the market really aggressively, because they know that if the dollar is rallying against the yuan, then it's probably because the yuan is weakening because they know something about the oil market that's taking place, or it's beginning to squeeze them first because they're short oil. And you can see how this moved in lockstep with crude prices during this time. And then notice the opposite happened, and it began to lead to the downside. And now what traders are doing is they're betting on the dollar to fall further against the yuan and make a new low, which is probably going to happen. And that is going to lead the way down for crude prices. And that seems very reasonable to me. What I would say is there is still, I have to pull up a chart on this. There's still so much positioning net long in the crude market right now. And let's just say if greater de-escalation took place in the market, the amount of premium that could still be taken out of the market is massive right now in the crude market. And let me pull up a chart of this, and I'm going to walk you through it in real time, because this is still will frame how much positioning could just get washed out literally in the next week. That people are so laser focused on the entire geopolitical situation, what's going to take place, or how much worse it can get, which is possible. I'm not saying it's not possible, but you want to think about both sides of the equation, right? Here's a chart of crude and crude implied volatility. Notice right here that the amount of, and actually let me just make this a little bit clearer for you. There we go. Notice that the amount of volatility that is in the crude market right now, an implied vol and options premium right now, is massive. So in the yellow line, you have implied vol for crude. This is still, at an 80 vol, 80% implied volatility. And what we are seeing is if you have a de-escalation, this vol would need to get crushed, maybe back down to 60 or 40, which could take, that I would say the range is still probably a 10 to 20, 10, I'd say 10 to 15%. I know there's a mathematical calculation for that, and all the quants will be nerds and talk about that. But at the end of the day, if you have a vol crush, you could still have, in the same way that crude gapped up 30% in a day, in a session, you could have the same thing happen on the opposite side, right? I know that you're having, crude move around and all of these, like the physical side of that, but you could have a massive unwind. And actually, notice right here in this red line how this spiked up. In this most recent move down in crude, what people did is they actually bought more calls. So right now, when this line spiked up, you had people pay a higher premium for calls in the crude market because they think it's going to go back up. And this is, basically call skew is back up to these levels that it was previously. So what, on net, what does all of this mean? It means that on a marginal basis, we're going to see another unwind in positioning, because this came down off this contract. And then what everyone did at these lows right here is they bought, basically they levered up with calls again right here, at least in the premiums that exist. However, what traders are now doing, and this is kind of the tension that's taking place in the FX market, traders are betting on, functionally in a proxy trade for crude to go down. And in the bond market, this is what we covered in the slides, people are basically betting on less downside right here. Traders are basically betting that ZN is not going to go below this level, and that the DXY is going to, probably drop further. So that's what, people are kind of shifted their bets on. But the reason why is there's still a ton of premium in the market for it to unwind. So if this, if you have more de-escalation and geopolitical risk, dollar's going to make a new low, which I think is going to happen. You're going to probably have bonds bid, but underperform stocks. You'll have the S&P 500, which is already happening, which, kind of, pretty straightforward. S&P 500 make an all-time high. And then on top of that, what you'll begin to have is, notice how gold and silver are up today. You're going to have gold and silver actually accelerate on geopolitical risk premium falling, because everyone that was betting on geopolitical risk rising, or gold rising on geopolitical risk, they just got flushed out right here. And now we're moving into a stage where macro liquidity is getting pumped into the markets because real rates are falling in the US and in other countries. So if you kind of feel like that's a lot to take in and a lot to kind of understand, what you want to do is begin understanding and mapping the drivers of all of these flows. And you can do that with all the models that I lay out on the Substack. You can go through all the educational primers and everything like that. And you can, go through how does positioning work on that. There's educational primers on the entire Substack for all this. But my view right now, gold probably higher, silver higher, hype a lot higher. I mean, hype and per are still my largest positions in markets right now. And, my view is Bitcoin Bitcoin has rejected every single low right here, right? Like it's just been chopping in this range, and one of the largest geopolitical risks unwind, and it hasn't done anything. Crude probably lower, because you just had everyone lever up right here. And, I think that the entire FX market, especially I would be watching the yuan tonight. If this makes a new low right here and we break this entire low, it's probably going to unwind even more crude positioning. Because again, it's not just US traders betting and hedging their risk in the oil market. I mean, China is one of the largest economies in the world, and they're trading oil all the time, and they're using it through their currency because they have to. So, that's taking place. And then also the dollar against the South Korean currency, the won, also likely to move lower as well. And if you watch the South Korean index, which has been melting up, by the way, you're probably going to have this make an all-time high as well. So you should be watching the Korean index and the Nikkei during the Asia session, because these are probably going to melt up. And you're probably going to have the FX pairs unwind as well. People are already betting on them. And then you're probably going to have interest rates remain neutral to maybe move down a little bit. But broadly speaking, again, this goes back to this chart right here, stocks are likely to outperform bonds. And that's why you want to watch this indicator right here that I built of the cross-sectional momentum of it, which is just vol-adjusted returns. So if you just look at the vol-adjusted returns of that, it'll break down all of that for you. And you can kind of go through, you could just rebuild this yourself and make it even better if you want with whatever you might be doing. So I know that's a lot of moving parts. I want to go through a couple kind of ideas and questions with James and talk through things a little bit more. But James, any initial thoughts with all of that, things that are unclear, or you feel like I should expand on a little bit more? Or what are you thinking?
There was a lot there, right? Because you're like across a bunch of different asset classes and stuff. But the takeaways from me were like that the positioning and the vol premium and the overall uncertainty that still exists is the fuel for exactly the setups that you're looking for. And it seemed like everything got to an extreme and like across all different asset classes. So like the pricing of the forward curve, the Z6 SOFR contract, oil volatility as compared to previous oil spikes, I guess an equity and bond unwind and hedging. Like everything just leads ultimately to kind of converging on one idea. And I guess it seems like my takeaway is kind of like higher in equities. And yeah, I guess the metals thing, I'm still a little like kind of unsure about. So I don't know if you want to expand on that a little bit, but like everything else kind of felt like one big trade.
Yep.
I guess. So kind of makes sense.
I think what I would say on the FX or the gold and silver side is that if central banks don't hike, then which I don't think they're going to hike this year. If they don't hike, just think about it like this: is like the central bank is always in a pickle because they don't dynamically move interest rates. Like if inflation, like think about the tariff shock, right? Inflation rose a little bit in the good side of things, but the Fed didn't do anything, right? They said, oh, instead of trying to hike interest rates, let's just pause, right? And they would rather pause. Even though, like, just think about the central bank as an entity. They are not this like dynamic trader that's always adjusting positioning, always shifting. I mean, maybe a little bit in the plumbing of the system, but like interest rate side, they're basically in a very linear kind of institution where they act or they don't act, and they're not dynamically mapping their actions to the system, right? Like it would be much better, I think, if, and actually probably a lot harder to trade markets. Well, I don't know if it'd be hard to trade markets. I think it would be similar, but if the central bank implemented an AI machine learning model that took all of their factors and dynamically changed interest rates every single day in real time to what's taking place in inflation risk. And obviously the longer end of the curve like does that. But if the central bank did that, it would kind of be a little, it'd be really interesting. But fundamentally they act or don't act only when things get more extreme, which is why a premium exists in markets for them, right? So if they don't act, they're likely just to pause or still cut maybe once this year. And they're going to pause into more money in the system. So if you have higher prices in the underlying economy, but then you don't have interest rates higher, you have the Fed pausing, on net, that pushes real interest rates lower and increases liquidity in the system and in financial markets, right? So that's taking place. Real rates are falling, which we're kind of like seeing in the charts. And then you have the, what do you call it? You have the dollar side of everything shifting as well, right? And you have the dollar, already weakening off of this geopolitical risk. And then on top of all of that, I share this chart for, let me see if I can find it, for paid subscribers the other day. And I'm just trying to find it right here. Let's see. Oh, here we go. Here is the capitulation that took place in gold relative to FX. So notice here in gray, or here in green and red is the basically put the skew for FX. So basically what happened is like when all these turn red, everyone is betting on, here's gold and all the FX pairs against the dollar. When the dollar is moving up and Euro USD is moving down and all these pairs are moving down, this is the dollar rallying against these pairs. And what's happening is put skew is blowing out. Everyone's buying puts on Euro USD, the pound against the dollar, Aussie dollar, and they're buying a ton of puts. And what is happening at the same time is that you have gold right here in blue. It also moves in lockstep with all these pairs, right? Now it's moving in the opposite direction in lockstep as they move up. Notice that right here at the low, which was at the low right here in gold, you basically have put skew. Everyone bought a ton of puts and premium kind of at the lows, almost like, in the order book where everyone kind of is like, oh, this is max pain. I got to dump my entire position and hedge. Yeah. That was this line right here. This is put skew. This gray line is put skew in gold. This extreme right here in gold, which also overlapped with all the skew in FX, which, I laid this out way before it actually even happened. We talked about this in the chat. That exact moment was on March 24th, which was right here. So right here in, March 24th, this day is when, you had capitulation right here, and then you had it consolidate right here. On March 24th, that's when I said in the chat, hey, gold is probably making a bottom here. And we're going to consolidate. And as long as the dollar moves down and crude moves down, gold and silver are probably going to move higher. That's kind of the stance I have on that. And I would actually be watching. So, for example, this entire setup for gold and bonds is something I would be watching really carefully, actually, because in this momentum indicator, what I'll do is I'll put gold in here. I want to be long gold and short ZN. And let's move this right here. And then put gold here. And ZN right here. This would be the ultimate test if I'm kind of right or wrong. So you can see ZN kind of moving, in lockstep, right? Gold kind of like flushing along with ZN, and now we're kind of bidding at the same time. The momentum of it, cross-sectional momentum, has been a little bit all over the place. But notice right here when we're rallying and both are moving up at the same time, I am watching very closely for gold to outperform bonds because they already moved in lockstep right here, right? Now what I want to see is, and I'll actually increase this a little bit just so it's a little bit clearer. What I want to see is this line move up and stay at a higher level, which means gold is outperforming ZN on a vol adjusted basis. And, I think to your point, you're kind of a little, it's not, gold hasn't really been bidding really aggressively, just kind of moseying around a little bit, and it's compressing a little. But my view is that once you have some of this premium unwind in markets, real rates fall further, the dollar make a new low, and everyone is like, oh, wait, we have to unwind all of these trades that we just bet on the end of the world for.
Yeah.
Then I think it'd be the ultimate kind of narrative pushback because people weren't mapping these flows. And they were like, oh, wait, geopolitical risk just collapsed in markets and the world's not going to end. Wait, gold is rallying? How does that make any sense? Gold's not supposed to rally when everything's going perfect. And I think it'd be kind of this perfect setup in that sense.
Yeah, and I mean, I'm looking at the like S&P chart. I mean, we're down 2.5% now from all-time highs, right? And I feel like most people still think we're down like 10% or something. You know what I mean?
Totally.
we're down 2.5%, and you had a complete kind of follow through on any of the ceasefire stuff and less people dying in Lebanon and all that stuff. You're going to see S&P back over 7,000, and you're just going to like the nothing ever happens camp is going to come out full-fledged, and we're going to see a big, we'll probably see Trump's approval rating like start to slowly creep back up. We'll see a lot of things. We'll actually probably be seeing the regime or like the market movement we were seeing a while ago, right? Where it was like stocks up, gold up,
yep,
dollar down. Yeah. maybe bonds up, but like you said, underperforming.
Yep.
So that feels like what we were in before when everything was just doing well.
Yeah, I think that, let me move back to this other chart really fast because.
And the gold thing makes sense, by the way. Thanks for explaining that.
Yeah, totally. I mean, I think what you're bringing up is I think the intuition that you have about gold is correct, because like there is an element where it hasn't whipped back as fast as equities, and you have to be like, okay, well, why is that happening, right? Like, why? And I think if you know the why behind that, then you can have a better timing on your decision making, which I think is super important, right? Like, I think that's that intuition is like super valuable, right? Yeah. Let's pull up. Here we go. So here is, let me put this here. Oh, let's put this. So here's a chart of where we are with equities, rates, and the dollar. And you'll notice that here's just in blue is the 10-year rate, which rose. You have the dollar, which is in yellow, that rose and now is falling, and then you have equities, and you just have this flip now, where now we have S&P up, rates up, and the dollar down. Oh, that's not right. It should be rates down. I need to relabel that. Rates down. And I think the interesting thing is that right now, if you begin to have some more momentum in this situation between rates, dollar, and equities, you could begin to see, one of the things that I laid out for everyone is this covariance matrix, which just means that like, what's the strength between three things? What's the strength between the interest rates, FX, and equities? And this shows the strength between three factors, whereas you look at a correlation, it only shows the strength between two factors. This was dropping, which was one of the reasons, in mid-March. In mid-March, it was beginning to drop, end of March, really, which was beginning to set the stage for me to say, like, I probably don't want to bet on further downside, because the strength that's flowing through the largest assets is beginning to weaken. It's just the same thing as like breadth, bearish breadth in the equity market was beginning to slow. And you're like, well, if breadth is at an extreme, I probably don't want to just get short equities when everyone is already short equities. And it's beginning to shift, and breadth is rising, even though the index is not moving. And so that's kind of what happened right here is you had the strength between stocks, bonds, and currencies all slow at the exact low. And it set the stage for all of those premiums to unwind. So I think what the interesting thing will be if that flips the opposite way, which is actually the melt up scenario that I think is beginning to take place. If you guys want to go see that, go to capitalflowsresearch.com and the most recent report that I wrote. And if you go to the very bottom, it breaks down that entire signals and especially thesis. And then you can find the video that I did yesterday on how it connects to equities. With where we're at right now, let me share. Let's find this. Here's a breakdown of the returns that we're at right now. And I think this is, we're updated on the day. Notice, let's go to a week. In terms of the equity rotation, we're seeing energy down as you have the leaders in terms of we'll look at returns. You can see energy is down right here in orange. They're down the most on the day. And then you have, communication services, utilities are up, materials are outperforming, industrials are outperforming. When you have materials and industrials outperforming, that just tells me that the inflationary spike still needs to make its way through the system a little bit, but we are still in the process of kind of transitioning out, but the energy side is beginning to dump off. So you're having some relief. And in my view, now everyone is going to shift back to realizing that the 6-month window we're in with AI and all the build out for AI is going to be the most influential thing that we have maybe in the next decade. And I think that the fact that industrials are rallying and the Russell is rallying more than the others, more than the S&P, is an indication that all of the entire AI theme and the AI capex build out is going to take the front and center focus again for the entire market, because that's the AI theme and the AI rebuilding of the economy and all the investment that's taking place, which like all the Mag 7 companies, they're spending like $1 trillion almost for capex. All of that money, like the people that are building that out are all the companies in the Russell. So all that money from Mag 7 is going to the companies in the Russell. And now the Russells and industrials and materials, they're all outperforming. And that's going to be, I think, over the next 2 months specifically, going to be the most important theme that takes place. And that's going to overlap with kind of some other, outperformance in like the food prices, fertilizer prices, kind of some other build out things. For example, one of the things that I covered for, well, I won't talk about what I covered for pay subscribers. That's for them in the behind the paywall in the bottom of this article. But I just think there's a lot of really important things to kind of be on the right side of as you move through these regime shifts.
Love that attribution chart there. That's pretty sick.
So interesting for this attribution chart. This is the outright returns. So just what the sectors are doing. And then you're like, okay, well, how much is that contributing to the index? So for example, the energy sector down, like for these days, it's down like 5% every day almost, right? Like down 5, down 5, down 5. And, or sorry, on a rolling basis, like it's down, this is a 1 week look back, right? But its contribution, you can see that it's orange right here. It's only contributing 22 bips of negative returns to the index because it has such a small weighting.
Oh, yeah.
So
that was always like a topic of like energy is super under-owned, right?
Totally. And, I think that's a very important point. I actually think utilities are going to be the next kind of big, I mean, we've already had a big run in utilities, but utilities are, one of the major sectors that's also under-owned. I mean, the utility sector just made an all-time high today, like just right now. And I think industrials are probably going to be next, but utilities are the entire energy side of the AI play, and they're just going to have a massive attribution. If you look at, let's go to factors, stock details.
You could argue the same for energy, most likely longer term, right? But maybe just not right now when there's.
I think it depends on it really depends on the company. So like, for example, like a lot of these companies that have, let me find, believe it's VST. Let me pull it up really fast because this will actually be really interesting. Let's see here. I have that the list that I was working through.
Well, it's just while you're doing that, it's an interesting point of like a lot of people. I think it's a cool example of how sometimes you could be focused on the things that are creating the smallest impact.
Yep.
And it's just like a little distracting from. It's like when some people worry about life's tiny problems, and you're like, well, that doesn't matter in the grand scheme of things.
Yeah.
You're letting it control your whole portfolio construction, when in reality, this thing over here is the thing that's impacting it the most that you're just disregarding.
Totally.
I'm going to run to the bathroom.
All right. Let's see. I can pull this up, guys. Give me 1 second. In terms of all of the energy plays that are taking place right now, there's, if we go to things like the real estate sector. Where is this? Here we go. Notice how EQIX has, they're at another all-time high today, right? And notice that they're the ones with the largest fundamental attribution that's from fundamental buyers as opposed to market or sector returns. So, when I think about how exactly the equity market is moving and why it's moving in the way that it is, then you have the different factors that are moving it. Is it from fundamental investors right here? Or is it from the sector investors here? Or is it just from the broad beta of the market? And, EQIX has one of the largest plays for the data center build out and the, sensitivity to that of, really any company in the world right now. And, my view is that when you kind of think about the EQIX, they have the world's largest data center and digital infrastructure REIT. So they're structured as this collocation and interconnection of platforms. And so when you see that rallying, and you see that rallying actually when the entire market is just sitting there, it's an indication about where we're going next, right? That tells you fundamental information. And so what I do is I go through all of these different names, which part of the distribution is being priced. Is it fundamentals, sectors, or the market? And then once you know that, then you can begin to find themes and, connect that to the macro regime and then begin to manage your risk around it. And that's one of the things that I'll be sharing with paid subscribers on the Substack is how do you map all of these changes in real time across every single thing and really bet on really these large secular trends. Because when you have EQIX, who is the largest digital REIT for all this stuff, making an all-time high and just melting up in this way, and they're leveraged to this entire AI play, they're outperforming the market right now. They're lagging all of ES, even Mag 7, they're outperforming that. They're outperforming Mag 7 right now. It's telling you about where the market views returns and the most important things, because the market will always speak with money and with movement. And you can have all these consensus reports or sentiment, whatever, but at the end of the day, if you have names like this just melting up, and it's it has the largest fundamental driver in the entire sector, and even in the market right now, it's just telling you where we're going, right? Like this entire AI theme and the pricing of it, we're now going to price the second and third order effects of it, and that's going to be the main idea for markets. And so I think that will be one of the kind of biggest things to think about moving forward. As a reminder to everyone who is on the stream today, the entire breakdown, charts, trading view models, and everything will be sent out to everyone on the Substack later today. So every single day, I will be doing a live stream at 8:30 a.m. Mountain Standard Time. I think it's 11:30 Eastern. And if you want to spend time really investing and saying, how do I build a base of knowledge over time? I'm going to pull together all of that stuff that you need to know every single day, do a live stream on it, send you all the charts, send you all the models, send you all the breakdowns, and those will all be 100% free on the Substack. And those will be at capitalflowsresearch.com. If you are kind of running behind or something like that, there'll always be a summary of the main talking points, so you can always see those. And my entire goal is map the macro regime, so I'm on the right side of it, and take a few large asymmetric bets that function as home run trades. The largest bet that I have right now is the Per Trade, which is a hyperliquid treasury company. If you go and just search on the Substack PURR, you can see all of the reports that I've written on it. go through all of it. And for all the paid subscribers, once you go through all of these different kind of factors, how they work and things like that, all the paid subscribers get the in-depth analysis on the interest rate strategy, FX flows, equity strategy, and all the structural macro reports. And those are sent out every single day. They're below in the paid subscriber section. So I'll send out the summary statements, all of the slide decks, all the models that I covered in the live stream. And then for paid subscribers, right below that will be the entire breakdown of all the proprietary models I'm running, all of the insights that I have for, okay, well, where do I think that the market and the drivers for it, how do they function, and how does that set the stage for taking trades and things like that? So all of that will be laid out on the Substack. You can get this entire slide deck on the Substack as well, with all of these different slides that I went through, and also all the trading view models that I shared in the stream today. And James, any final closing words before we end the stream?
No, I just think reiterating that this one was a little in the weeds for sure. It's definitely pretty deep, but I do think it matters to show up every day and try to continue to ingest this and try to follow along here, because it can matter quite a bit for your trading life. Like there are certain times when certain inflection points and positioning gives you opportunities, and I think you're going to be a good resource for a lot of people. And who else is really doing this? So really cool.
No one at the moment. Hey, I'd love someone else to do it so that I can just kind of hang out all day. And
that's right.
I'll just download their slide decks and I can just kind of go trade and do my own thing. But someone else should do it. If you guys, I think everyone should go do a live stream. Go write a bunch of reports, pull together all the data, pull together all the AI agents, build your own process out. Like all of the resources to do all of that is literally all in the Substack on the main page. So you could just go do it all. All the education is free. You just have to put in all the time and work, go buy all the data, go through all the agents and everything like that. And then go through the stream every day. I would love to sit in other people's streams and do that. I think that'd be cool.
Sounds super easy. Super easy.
So, all right, everyone, thank you for joining the live stream. I will see you all tomorrow. Come tomorrow. If you have any questions, put them in the live stream or message me with them, and we will go over them in the live stream tomorrow. Thank you again for joining, and I will see you guys on the Substack at capitalflowsresearch.com.